If you're planning to buy a car with cash, you need to understand this before you walk into the dealership, because paying cash sounds powerful. I hate debt, so I get you. I don't have car payments as a result, but it comes with its own set of challenges, and this is one. Because paying cash sounds like you should have more leverage, but in many cases, telling a dealer up front that you're paying cash can actually make you overpaid. Here's why. Most people think the dealership makes its money on the price of the car, but that's only part of the story. In fact, public data tells us it's about 22 to 25% of the gross profit. So if your car payment, buying the car, is $1 that they stand to make $3 on other stuff. So why is this important? On the new car, on this guy, the dealership might make a few $1,000s on an actual vehicle sale. But at many dealerships, that front-end profit is only a fraction of the gross profit opportunity. The rest comes from things that happen after the car price. Like what type of other stuff? Financing, extended warranties, gap insurance, paint protection, tire and wheel upgrades or coverage, maintenance packages, accessories, service, parts. The car gets you in the door, but the real money is often made after you buy the car. Like everybody knows in the finance department, that's the best salespeople. Why? Because that's where they make $3 versus $1. So if you walk into that dealership and immediately say, I am paying cash, you just told the dealership that one of its biggest profit centers might be gone, or a big portion of it. No finance reserve, no loan markup, possibly fewer finance office products, less opportunity to make money on the back end. So what do you think they're going to have to do? They've got to make more money on the front end, meaning the price of the car. All of a sudden, they're not going to be nearly as willing to negotiate. And that's why cash buyers can accidentally lose leverage. Not because cash is bad. Cash is great. But showing your hand too early can be expensive. So today I want to explain how this works, how dealers get you focused on the wrong number, why leasing can look cheaper while still being expensive, and how to buy a car without getting trapped by the monthly payment game. Because the question is not, can I afford the payment? The question is, what is this actually going to cost me? Let's start with the biggest trap in car buying, the monthly payment. The average new car payment is now around $767 a month in the US. That's crazy. More than 1 in 6 new car buyers is paying over $1,000 a month just for the car. That's not no insurance, no gas, no registration, no maintenance, just the car payment. And the average new car loan term is now close to 69 months. That means people are spending nearly 6 years to pay for a vehicle that it loses a huge chunk of its value as soon as they drive it off the lot. Okay, that's why gap insurance is actually important, guys. If you buy a new car for $50,000, it's worth $40,000 the next week when you're driving it around. You want to make sure if they total your car, that you're not getting a check from the insurance company for $40,000 while you owe 50 grand on that thing. Enough of that for a minute. Let's focus on buying the car. And by the way, the dealer can sell you gap, but you can also just go to your insurance company and buy gap. But remember, that gap is sitting in here. Okay, so we have these huge monthly payments and long-term loans. How do we get here? Because the system is designed to keep you focused on one number. What's that one number? You know what it is. It's that monthly payment. It's what everybody advertises. $299, you get your car. $0, you could drive it off the lot. If they can get you focused on a monthly payment, I can make almost anything look affordable. I can stretch the loan. I can add in a bunch of fees. I can bury products in there. I can adjust the down payment. $299 a month with $7,000 down, or first month free, no payments until next year. We've all heard this stuff. I can talk about what you can comfortably afford at the dealership. But the number that matters is not that monthly payment. The number that matters is the out-the-door price of that vehicle. That means the full price, including taxes, title, registration, any of the dealer fees. They're going to charge you stuff to do paperwork, add-ons, products, anything else that you're trying to include in that. You want one number. What is the total out the door price? That's the number you negotiate first. Not the payment, not the interest rate, not the warranty, not your trade-in, not whether you're paying cash. It's price first. Financing second, products third. Because a $4,000 car with $5,000 of add-ons is not a $40,000 car. It's a $45,000 car. And a $35,000 car with a, let's say it's a $1,000 dock fee, $1,500 protection package, maybe $899 tire package upgrade, and a $2,000 service contract, that is not a $35,000 car. It is something else entirely. But if you only focus on the payment, you may never feel it. They'll just stretch that loan. A 60-month loan becomes a 72-month loan. A $900 payment then magically becomes, let's say, a $700 payment. A $700 payment becomes a $599 a month payment. And the buyer says, great, they worked with me. No, they may not have worked with you. They may have taken advantage of you. They may have stretched the loan. They may have increased the total interest that they're charging and buried extra products into the deal. As soon as you start adding to the term, you can bury all sorts of profit for the dealership. They do into those numbers. I remember falling for this once. I was thinking in my head, hey, I wanted a 48-month term on a car, and it was a Toyota, it's a great car, and I was shooting to keep the payment below a certain number, I think it was $300 a month. So the finance salesperson, usually the best salesperson in the dealership, they tried to tie me down immediately. What if I can get the payment down to $299 a month? You'll buy the car today. Could you initial right here? And I was like, yeah, I think I would. So he immediately goes to 60 months. It went from 48 months to 60 months, and he added a bunch of service products to reward me for my great, hey, I'm going to throw this in and that in. No, they didn't throw anything in. They just added it into the price. I saw what was happening pretty quick, and I laughed my way out of that dealership. I thought it was pretty funny. I was like, Toby, you almost walked into that one. But I don't think it's funny anymore because people are falling for it. And that's why wealthy people ask a different question. They don't ask how much down and how much a month. They ask how much. That one question can save you thousands of dollars on this one. Now let's get back to the cash buyer problem. Paying cash is not the problem. The problem is using cash as your opening move. If you say, I am paying cash, the dealer knows immediately that financing profit may not be available. For example, the finance reserve that the dealer makes, say they get a loan at 4% and they can charge you 6%, or they get 6% and they can charge you 9%. The dealership makes that spread, that extra 2%, 3%, whatever it is. It's called the finance reserve. That just went poof to the dealership. I'm buying cash. That's a poof. They just saw, they heard it. It left. And since the dealership may make a significant portion of its gross profit from everything other than that car price, you may have just taken out a big piece of the equation. So they become less flexible on this $1. That may be what they're looking at going, that's all we can make. That doesn't mean you should lie about paying cash. It means you should control the sequence. You can say, I'm looking at all my options. Or, let's agree on the out the door number first. Or, I want to settle the price before we discuss financing. That keeps the negotiation focused where it belongs, on the actual cost of the vehicle. Then, once you've got the out the door price and you've agreed to that, then you could decide how you want to pay. For cash people, maybe you should finance it. Remember, the dealer immediately thinks, oh, this is great, I'm going to make money, and then you pay it off. Right? You finance it, 2 months later you pay it off. Maybe there's a manufacturer incentive or a dealer rebate tied to financing too. But if you do that, you just got to make sure that you know going in that you're going to immediately pay it off, that you check the terms of whatever it is you sign carefully. Like, just make sure you don't walk into a post there. Make sure that you can pay it off. Now, some manufacturers have really low annual percentage rates. Like, sometimes there's 0. but they have a minimum loan duration requirement. Pay the loan off too early and you may lose that incentive. The interest rate may recheck, or they have some sort of payment that you all of a sudden have to make, prepayment. So check the specific terms before you assume you can just finance and immediately pay it off. You might ask simple things like, hey, is there a prepayment penalty? When is the loan booked? Are there any products required to get this deal? Do the financing charges or fees wipe out the savings, right? If the financing incentive saves you $2,000, but the loan fees or required product cost you an extra $2,500, that's probably not a deal. You got to measure it, but you don't want to know going in. Now let's talk about something else entirely. Let's talk about leasing. This is an area that is actually very appealing to folks who need a nice car because of what they do. Like, I know who you are. Maybe you're a realtor. You know, maybe it's the car is essential to their job, and any downtime, if they have to fix the car, is super costly. Like maybe you're a driver or a delivery person. But watch out. Leasing often feels cheaper because the monthly payments might be lower. But leasing is not magic. Leasing is just another way to finance the use of a vehicle. And the easy way to think about it is take a new price of a car. Subtract what the car is expected to be worth at the end of the lease. Let's say you did a 24-month lease. The difference is the depreciation. That's what you're paying for. So then you add in all the interest, the fees, the taxes, and restrictions into that amount. So for example, let's say a new car is $50,000 new. In 36 months, maybe it's expected to be worth $30,000. That means the lease has to cover $20,000 of depreciation over that 36 months. Then you add financing and fees, and maybe you're at $24,000 total. Divide that by 36 months. I'm just using this as an example, 36-month lease term. And that ends up being about $667 a month. And that's before you add taxes. When you add taxes, then you're probably over $700. So let's call it $720 a month. Now compare that to buying. If you bought the same $50,000 car, added taxes and fees, and financed it over 60 months, your payment might be closer to $1,100 or $1,150. So that lease looks a lot cheaper, $700 versus $1,100, and that's the trap. It may be cheaper monthly, but you're still paying for the depreciation, the financing fees, the restrictions on the car. You only have so many miles, you might have wear and tear, all this stuff. The leasing company is not eating the depreciation out of kindness. You're paying for that depreciation. It's just packaged differently. And here is something most people miss in a lease negotiation. The interest rate on a lease is called the money factor. Dealers can mark it up, just like they can mark up a loan interest rate. You'll not see it advertised. You're going to have to ask for that rate. And if they quote you a money factor, 0.001, you have to multiply it by $2,400 to convert it to an approximate interest rate. So in my example, let's just say it's 0.001 money factor, that's 2.4% annual percentage rate. Now you know. And now you know what you're paying for before you sign. To be fair, leasing can reduce certain risks, right? If you hand the car back at the end of the lease, you avoid the uncertainty of having to sell it yourself. You're in a vehicle with a very predictable maintenance history, right? You have a shorter commitment. That has some appeal. Like, I don't have to, everything's pretty much going to be under warranty, so I'm not taking a bunch of risk. But leasing does have its own end of term risks that people oftentimes overlook. There's these excess mileage charges. I might have a lease, 36-month lease, but it's 10,000 miles a year. And if I'm using it a lot, that could be a problem. I have wear and tear fees, like if it's not in great condition. Disposition fees they might throw on there. You fill in the blank. They may just add some weird things in there. You got to make sure you're looking at it. And many people just hand back a lease expecting that they can walk away and say, whew. But you might be find yourself writing a check, maybe $1,500, $3,000 at the end of the lease that you just didn't know was going to come. So while leasing can reduce some risks, it does create others. But some people love leases. But don't confuse that lower monthly payment with a better deal. For most people, Leasing creates a permanent payment cycle, right? You pay the depreciation, the most expensive years of a vehicle's life. You turn it in and you start over again. You do that again and again. Like you always have a great brand new car, right? Tough for building wealth, but if you've already made it, that might be something you really consider, or if it's something that you're using in your business, it might be worth it. A better wealth building approach is usually pretty boring. You buy a reliable vehicle, you avoid overbuying, like you don't need to get a Corvette. Maybe you're going to get a Prius, right? And you pay it off quickly, pay cash if appropriate if you can. Drive it longer than the loan term, right? We don't want to have a 5-year loan term and then you turn it right back in and buy another one. You may as well have leased it, right? Use the years without a payment to invest. So if I buy a car and I have a 4-year loan term and I own it for 10 years, I had, 6 years where I didn't have to pay. Make sure that you're investing that money that you're saving, the car payment that you used to have, invest it, build reserves, cash reserves, pay down other debt, buy assets so that they can pay for your car, buy a rental property, take that money, use it as a down payment, let a rental property pay for your car, or do dividend producing stocks, let those pay for your car. And just remember this, like the best value cars, for all you folks that are getting started, or you're just like, hey, Toby, I just want to know what's the best type of car to buy as far as cost of ownership. I mean, the best value cars, they're not usually very exciting. I think that the Honda Civic is the best. It averages something like 14 years. That's how long they last. So paying a loan for 6 and no payment for 8 years looks decent. Like they don't cost a ton to operate. There's other cars like the Toyota Corolla and the Prius, Mazda 3, cars like that. They don't make you look rich, but they do the job without bleeding you dry. And that brings me to the business owner trap. Ugh, I see this all over social media because business owners are especially vulnerable when they hear someone online say, just write it off. I mean, I love deductions. I'm a tax attorney. But a deduction does not make something free. If you spend $80,000 to save $25,000 in taxes, you still spent $55,000. You still spent that money. And with vehicles, especially when you're using it for business, it can get even worse. If you depreciate a business vehicle and then you sell it, you may have depreciation recapture under IRC section 1245. Ordinary income. The IRS will want back a portion of those deductions, meaning you owe the taxes anyway. If your business use, by the way, drops below 50%, and you did bonus depreciation, you watch one of these guys who's like, buy a G-Wagon, write it all off, buy a Range Rover, write it all. You drop below 50%, you get to recapture any of the bonus depreciation that you took. You get to have just straight line depreciation. Anything else, it's coming back to you. And that can be, let's say, inconvenient. You only get to write off the business portion of the depreciation too. So if you're using it 30% for business, 30% of that depreciation is what you get to use. You don't get to use it all. You have to keep mileage logs. And if you don't, you may have substantiation problems if you're ever examined and lose the deduction completely. And if the vehicle is mostly personal, the deduction may not work how you think. All these people telling you something that they think you want to hear, so you click on their stuff, but that's not the way it works. So do not buy a giant SUV because someone online told you the IRS will pay for it. They won't. You pay for it. Then maybe if you qualify and document it properly, you get a deduction for just the business usage of it. Then, depending on what you do with the vehicle, you may end up paying taxes on the recapture, and you're right back where you started, just poorer. The first question is not, can I write it off? The first question is, would I buy this if there was no deduction? If the answer is no, slow down. A tax deduction should improve an already sound decision. It should not justify a bad one. Now, if you're already in a bad car deal, do not panic. Get the numbers. What's the payoff? What's this car worth? What's the interest rate? What is the remaining term? Are there prepayment penalties? Because you can actually refi some of this stuff. Are there warranties or products that you can cancel for a prorated refund? A lot of people do not realize that some of those, what they call finance office products, that think service packages or insurance, you can actually cancel them. Not always, but a lot of times. So check the contract. It's at least worth reviewing if you're in a bad deal. And if you're upside down, just be very careful. Do not roll negative equity into another car loan unless you absolutely positively have to. That's how people end up buying a $35,000 car with a $48,000 loan. Make that make sense, right? They drag the old mistake into the new mistake. If the car is reliable and you can afford it, the best move may be to pay it off aggressively and then just keep driving it. You made a mistake. The mistake already happened. Don't compound it by trading into another bad deal. So here's the bottom line. When you buy a car, the dealer wants you focused on payment. You need to focus on the total cost. At many dealerships, a significant portion of the gross profit comes not from the vehicle price itself. No, it comes from financing, warranties, service contracts, insurance products, parts, accessories, service. So if you're a cash buyer and you announce that too early, I'm buying cash, you just eliminated a bunch of that back-end profit opportunity for the dealer. Now they gotta get you on the price of the car. And that's how cash can hurt you. And before you lease, finance, or buy your next vehicle, ask the question that changes everything. Not how much down, not how much a month. Ask, how much is this really costing me? That one question can save you thousands. Now, please, folks, give me your best auto purchase stories. Let me know if you think I'm all wet or if you agree with me. Share this with your friends. Like and subscribe if you like this type of content. I put out multiple money-saving videos each week. Would love to share them with you, so subscribe now. Good luck, my friends.